Hello, friends. Today I have a very wonderful and a special guest. Let me have the privilege of welcoming Mr. Keyur Majmudar, who is the managing partner, principal officer, and CIO of Bay Capital. He comes with 30 years of experience covering investment banking, equity advisory, and fund management. And prior to that, he was EVP at Kotak Securities, where he conceptualized and built on non-discretionary PMS. And he was SVP at Kotak Mahindra UK in London. And he was also involved in building out the offshore asset management business of Kotak UK. And Mr. Kaur holds a bachelor's degree from Mumbai University and master's in management from Boston University. With this small introduction, let me welcome Mr. Keyur Majmudar to the show.
Thank you, Venkat. Great to be here with you and appreciate the opportunity to speak with you and the investor community at large. So, thanks again for the
Yeah.
opportunity.
Yeah, great, sir. So I have done a good amount of research about your company, Bay Capital, and at times I would like to become a devil's advocate here. So ask you questions on
Yeah,
that. So
for sure.
yeah, my first question is that you have a principle of responsible investing which has come from UNPRI code
Yeah.
of contact. I would like to understand more about it, as well as the deep domain knowledge which you have in public and private markets in India.
Right. Yeah. So, let me take the second one first, Venkat, if I can.
Yeah,
Uh,
yeah, please.
so, so just as a quick background, as a firm, we've been around for the last 16 odd years. So that is a fairly long vintage, and as you can imagine, it has allowed us the opportunity to traverse through multiple market cycles, right? Upswings,
Yeah,
downswings, and what have
yeah.
you, right? I think the point you have mentioned is quite pertinent, because I would say we are one of the few sort of managers who have had this unique ability to have invested across both the public markets and the private markets, right? And again, as you can imagine, the ecosystems are very different, the opportunity
Yes.
sets are very different, and therefore the approach also has to be a little bit different, right? So it is simply because of our journey over the last 16 years that has enabled us to sort of traverse both. I'll just spend 2 minutes on giving you some context as to why we've been able to develop this expertise, right? And so we started life in 2007 as an investment firm, and at that point of time we were managing a public equities fund. As you can imagine, in 2008 the global financial crisis hit us, and as we were sort of maneuvering through that phase and repositioning the portfolio, etc., as we moved into late 2009, early 2010, one of the things that became very clear to us is that the crisis is sort of slowly fading away, and over a period of time things hopefully will start to get a lot better. And many of the opportunities that we were seeing, right, were available to us, and these opportunities were both on the public market side as well as the private market side, right? Now, what happened at that time also was that the mandate of the fund that we were running sort of did not allow us to invest in a broader spectrum of investments, right? So what we did was we said, yes, while we are managing the public market fund, we will look at some of these opportunities and take those opportunities to our existing LPs and have them co-invest with us on a sort of SPV by SPV or deal by deal kind of basis, right? And some of these investments were on the public market side, and some were opportunities on the private side, basically unlisted. But we were also very sure that we do not want to invest in on the venture side of it, right? And this is, remember, talking about 2009 2010. So venture was of course it was existent, but
Unexplored territory. Yeah,
in a
unexplored.
very
Yeah,
different format,
yeah,
as you can imagine, at that time compared to what zone we are in now. and even on the growth capital investing stage, right? At that time, the opportunity set was again fairly limited because we're talking about 2010, right? Almost 15 years ago. And so that's how we were able to build this expertise. We ended up doing close to 12 or 13 of these different investments. Most of those, of course, are either now listed companies, or we've been able to sell and liquidate most of those, right? So it's really because of this journey over the last 16 years that has given us this opportunity to have done both, right? And I
Yeah.
think just finally I'll pause by saying that what has been the most important element that combines this is really our long term orientation, right?
Okay.
Because both on the public side as well as the private side, the ability to truly think long term, which is 5 or 7 years plus, and truly think about being owners of businesses, right?
Yeah.
Now, it's very easy to say we own businesses or we think of ourselves as owners, right? But it's only when you invest in the way that we currently do or have done in the past that that is truly put to the test, right? Because we really think of ourselves as owners in some fashion of those businesses, and because we have a 6 7 sort of year view of our investment, we are able to go through shorter term sort of shocks in our stride, right? And this is the reason why over this time we've been able to sort of ride out many storms that have come, right? So I think in that sense I would say we are fairly unique because we have this deep understanding and appreciation of both public and private markets as well, right? The first part of your question was really around PRI, right? Now, as we are advisors to an offshore fund. Our orientation has always been managing money in India, but for overseas investors, right? And again, right from pretty much day one of our single biggest factors, today ESG, of course, is a very
Big
good
thing. Yeah.
buzzword, and
Yeah.
things like that. Many people talk about ESG in a particular way. I would say with a great deal of conviction, Venkat, that pretty much throughout our journey, right, on the ESG part, the G has always been a very important factor, right? Even before
Okay.
ESG became such a interesting buzzword,
Mm.
or even before we were official signatories to the principles of responsible investing, our focus was always on the governance part of things, right? Because that is a very important filter in our investment process, as we will hopefully get to talk about. And when you overlay that with the ENS part, it just becomes a more composite kind of holistic way of looking at things. One of the other things that we have very consciously also done, Venkat, from our side, is that many investors, right, simply have a very sort of checkbox kind of approach to responsible investing, or they use standard sort of tools and templates which are third party, right? uh, and we have gone that extra step and sort of created our own proprietary framework, right, on the responsible investing principles, and said we will have our own methodology. We will craft our own approach because of the way that we invest. Using any external tools is not really reflective of really how we think about ESG in that sense. So we've got our own tool kit, if you will, and there, in essence, we have a 50% weightage for any business on the G part of it, and an equal 25% weightage on the ENS
Yes.
part of it. And within that, there are certain parameters, and almost all of our portfolio businesses are at least annually ranked by ourselves on each of those metrics, and then we have arrive at an overall score, right? So we think we do this in a fairly scientific manner. We think we do this in a manner that truly does justice to the principles of ESG, right? And
Yeah.
certainly it helps us showcase our firm to the larger investment community. So that's how we thought about ESG, and that's why we believe we're doing justice to the PRI in the way that it should be.
Wonderful. And since we have just came out of elections, I will just deviate from here.
Sure,
And as
sure.
you know that the BJP government will be forming a coalition government. So I
Yes.
just wanted to hear from you, what are all the sectors which was looking attractive, which will have a headwind going forward, or do you see is there any bottleneck in the
Yeah.
good reforms which is being done in the last 5 to 7 years?
Yeah.
Yeah.
No, no, it's a
When-
very important and contextual question, as you can imagine, right? I think, uh, you know, we put out monthly fact sheets, right, Venkat?
yeah. Yes.
Um, every month, right? And last month in our April fact sheet, one of the things that we had highlighted, right, and this is available. It'll be good for you to read as well, right? And as you can imagine, as we were rolling into April and even May, right? Uh, the fact that the current dispensation would come back was pretty much a near certainty, right? And
Yeah.
as the election rhetoric was on, right, one of the things that we started thinking about was that there is such a great consensus about something, right? So what if, it's just a what if,
Yeah.
uh, even though it's a very low probability event, right? 0.0001%. What if it's something different, right? And
Hmm.
so therefore we spent a little time thinking about it, and we wrote a few paragraphs. And we're not saying this today. It's something that is captured and memorialized almost a month and a half ago. And at that time we were very sure that look, there is a certain directionality that exists in terms of India, its economic growth and reforms, and that directionality is not going to change, right? And as we have seen in the past, irrespective of any construct, the broader India story has now gained a momentum that will continue, right?
Yeah.
I think what may change is the pace of things, right? Because in the last 10
Okay.
years, we've got used to a certain pace of,
Yeah.
of, of of getting things done.
Reforms. Yeah.
That pace is going to be affected for sure, right? And so therefore, I think that's something very, very important to keep in mind. I would also sort of make the argument, and again, there are many reports and writings out there, is that one of the reasons for this outcome was that there are some real pain points in the economy which we sort of maybe in the metros and in our offices we're not able to fully appreciate, particularly rural distress, right?
Okay.
And if we sort of travel, we all travel into the hinterland, right? And from time to time we do our own channel checks, and this is something that certainly gets picked up, right? So there is rural distress, and perhaps that was not very sharply addressed for a variety of reasons, right? I mean, there were sort of things that are targeted, but probably not enough that was done, right? And probably that was reflective in how the consumer businesses, right? If you look at the typical FMCG businesses and
Yeah.
how their volume growth and their commentary up to say last quarter was around rural versus urban, or volume growth generally being very lackluster, right? And various reasons have been given for that. And I think one thing that's sort of definitely going to change, which is I think by and large known, is that one of the first few things in terms of policy or even the budget will be addressing this rural distress, right? Now it could be addressed in several different forms. It could be just in terms of this is direct benefit transfer. It could be in terms of increasing MSP, or it could be just with certain welfare schemes that are more targeted, so that end distress goes away immediately, right? And I think that certainly augurs well for many consumer businesses. Of course, you've seen what consumer businesses have done in the last one
Yeah.
week, 10, 15 days, or what have you. But I think that's one sector that will sort of stand out to do well. Many of these consumer businesses have not really done too much from a stock price performance
Yeah, in
perspective.
the last
So
three
you
years.
see this
Yeah.
little readjustment happening. And the other thing is, of course, also businesses which are sort of beneficiaries of growth coming from tier 2, tier 3 cities, right? Hopefully we'll get to talk about this, but one of the very interesting businesses that we own in our portfolios is actually from Tamil Nadu, right? You might be familiar with Five Star Business Finance, right? This is
Hmm.
basically a very, very unique kind of business, and we've known them for 3 or 4 years now. I would dare say that there are very few businesses out there which are executing at scale in the way that they are, right? And their target opportunity market is really tier 3, tier 4, tier 5, tier 6
Oh,
towns, and larger sort of pockets of villages, or smaller towns, where they lend money to the more unorganized side of the market, right? And I think many of these businesses will now start to come to the fore, right? And I think anything that sort of targets Bharat, right, as opposed to the urban India, will end up disproportionately doing better. So I think those are the pockets. I think on the flip side, right, particularly over the last 12 or 18 months, many narrative businesses, as they are called, right, good solid businesses, but built on very strong narratives, right, about maybe around defense, or maybe around capex or what have you, right? I'm just using these terms very broad way. There was a very sweeping narrative, right,
yeah,
that defense spending in the last 3 years has been so much, so therefore in the next 5 years or 10 years or 15 years
extrapolated. Yeah,
will extrapolate and grow at the same pace, right? And yes, you could argue that 2 years back, 3 years back, there was a valuation comfort that was there, but I think today in many of these pockets, because of this extrapolation, the valuations are just very bizarre, right?
yeah,
So I
yes,
think one of the things that will happen from all of this, right, is that it will force investors, right, to focus more on earnings growth and sustainability of earnings, as opposed to extrapolated narratives, right? And I think
yeah,
that's the sobering down that will happen, hopefully. uh,
yeah,
you know that it will force investors to think about earnings and say, can ABC PSU stock, which is trading at 50 times earnings, really be able to compound earnings at
mm,
that kind of
yeah,
number for the next 5 or
for
10
a long
years, right?
period. Yeah, yeah.
Long period. And I think in many cases the answers would be
No,
things which don't give too much of comfort, right? So
no,
I
yeah,
think but that's the nature of markets, Venkat, right? We've seen
yeah,
many
yeah,
cycles.
true.
I think so many things will change for sure, but from our lens, right, what has always, Venkat, served us well in the past is to always ask the question, what will not change, right? Because
Okay,
that helps us focus on the things that matter, right? Because we can always say, oh, there will be 10 things which will change, right? But for us as investors, if we ask what is not going to change, right? The fact that the India story is pretty much in place is not going to change. The fact that the basic tenets of the consumption sort of opportunity is not going to change. The fact that earnings growth will become an important driver of stock price returns is not going to change, right? I think so. If we focus on
yeah,
those kind of opportunities, those kind of businesses where compounding returns are
happens.
possible,
Yeah,
then I think then we'll be in a good space, right? And I would make the sort of fairly convincing argument that from a positioning standpoint, we are positioned quite well to capture some of these tailwinds that exist, right?
yes,
So yes, I think the result has come as a surprise to most people who were observers, but that's the nature of things, right? I mean, nothing can be taken for granted. Things always surprise, and
yeah,
it's always best to be prepared for the unexpected, right? So that what if is always a question, right, which is again the
yeah,
devil's advocate. So you started the
yeah,
devil's advocate, right? And I think that starting point is always important, right? And to always say that it's a one in a million probability, but what if that happens? How are
yeah,
we positioned even for that, right? Or will we start to panic? And fortunately
yeah.
for us, we think we are positioned in a fairly solid way, Venkat.
Yes, and I've gone through your both your India Leaders Fund as well as your India Opportunities Fund, and one thing which
Yeah.
is very striking is that you maintain a higher active share than the market, and
Yes.
also you have a low volatility. So, can you explain
Yeah.
on the process how it is being done
Yeah. So I think
with some
that's a
examples? Yeah,
yeah. So that's a very good question, actually, Venkat. One of the starting points in our entire investing approach, right, is a whole list of things that we don't invest in, right?
yeah,
So So we don't invest in businesses which require a lot of capital. We don't invest in business where return on capital, the ROC is low. We don't invest in businesses which are commodity kind of oriented. We don't invest in businesses which are government owned, for example, right? So we don't own any PSUs, right? And even going forward, no matter how great the opportunity, those are pockets which we stay away from, right? We typically avoid intensively cyclical kind of businesses, right? So I think there's an entire piece of the broader market that is sort of taken away, right? Now, as you can imagine, inherently doing this takes away a large part of sort of the addressable investment landscape for us,
Universe.
right? So this is, of course, the first step in going towards the active share number, right? Because we don't invest in many of the names that are part of in the top 10 or top 15 of any index, right? You will not see us owning Ambuja or a cement business or a steel business or a power business or what have you, right? So large chunk of
Yeah,
the
nothing is there in infra also. Yeah,
so nothing is there in
yeah,
infra, right?
infra
Because
also.
again,
Yeah,
infra, the counterparty is the government of India. Balance sheets are leveraged. Return on capital numbers are not great. These businesses end up doing well in a up cycle. In a down cycle, many business models are not well tested, and so they sort of falter, right? And in many of these opportunity sets, businesses tend to be sort of small cap or mid cap, where things can get very very violent very quickly, right? So that automatically takes our active share number far higher, right? And the second part is really that, again, in terms of how we think about investing, right? So I can say with a great deal of conviction that we are not investing for momentum, right? So it is very much okay if something is going up 10%, 20%, 30%, and we have not invested there, right? So we don't want to chase stocks, or we don't want to chase themes, or we don't want to chase narratives, right? uh, One of the important things in our mind is that how do we sort of try and protect downside to the best extent possible, right? Because when things get volatile,
yeah,
you want the portfolio to have some resilience, right? And I think that's sort of the balance that we always like to draw, right? And this is what in many ways explains the relatively lower volatility, and obviously the higher active share number, right? I will also finally just pause, and before that, just say that our orientation, right, is non-benchmarked. Our orientation is bottom up, and our orientation is to look beyond, large cap, mid cap, small caps, right? So, for instance, today we are not saying to ourselves that large cap is likely to outperform small cap, and therefore we need to have a certain percentage of the portfolio in large cap businesses or what have you, right? That split of large, mid, small is really an outcome of our work, our bottom up research, to say that this is a great business. It happens to be mid cap, or it happens to be large cap, or what have you, right? So we're not constrained by sort of these very static
Hmm.
numbers saying
Yeah,
40% large cap, 50% large cap, 20 mid cap, 20, and we have to play around with that, right? So it's an unconstrained kind of thing. We can move across market cap buckets, and that leads to dynamic sort of portfolio management in that sense, because we position for where the opportunity sets are, right? So I think
yeah,
those are the broad pointers. And final thing, just on processes, this filter of knowing what not to do is a very very strong filter, right? It cuts out many things. And on the other side, the other filter, of course, is around market cap, right? So we are typically looking for businesses which will have a market cap of roughly around 2,500 crores or higher, right? So we
hmm,
are not looking at the 400 crores, 500 crores, 1,000
yeah,
crore kind of range, right? Because that requires a different kind of orientation, right? Because there, it's small cap businesses are at maybe early stages of their growth. There is a different kind of risk that exists, right? Whereas with slightly higher market caps, businesses have a higher track record, and a better scale of operations where we believe that some of the risks are reduced, right? So I think
Yeah.
those are some of the things that we think about in terms of our process that leads, to those two numbers which you pointed out.
Yeah, and I also see some similarities between your Leaders Fund and your India Opportunities Fund, both in the AF and PMS. Is there
Yeah.
any specific reason for that? And my second question will be, can you also throw some light on the co-investment opportunities which were given to the investors and how it has benefited them in the portfolio, especially on the
Yeah.
AF side? Yeah.
Correct. Yeah. From a team standpoint, right, Venkat, we have one cohesive team that works together, right, in
Yeah.
identifying investment opportunities. So the way we think about the AIF and PMS is really that these are two vehicles to deliver a certain investment philosophy or investment approach, right? And so while me and Nikunj, who's my colleague, are the two sort of managers managing these two strategies, obviously we work very closely with the rest of the team in terms of just the ideation and things like that, right? So that's number one. It's a cohesive team, and we are just trying to sort of deliver a certain investment approach. Um, it is because of this that typically you would say about 50-55% of the portfolio being common, right? Between the two, right? Now that's again not a hard and fast number. It just so happens that
Hmm.
both of us end up liking certain ideas. Both will have
Okay.
it. In certain cases, only the AIF which I run will have a certain name. In some cases, only he will own it, right? And that's the individual sort of discretion and conviction that exists. But by and large, it's going to be 50-60% of the portfolio which will have sort of commonalities, right? Because the team and the outlook and the approach is broadly similar, right? And so that's how sort of we are kind of positioned, Venkat.
Yeah. Wonderful. And since you have a very differentiated process, so and do you also bring in investors with a small ticket size? Like, and tomorrow the accredited investor framework is getting popular in the
Yeah,
SEBI network. That I wanted to know. And do you
correct.
also have any specific fund for the gift city oriented investments which you are proposed to launch or something like that, as you have been an offshore fund?
Right. Yeah. So on the
Yeah.
gift side, right, we don't have any existing vehicle or structure. Have we, sort of looked at it in a very cursory, preliminary fashion? Answer is yes. But there is no tangible
Hmm.
movement to either setting up a vehicle or fund or entity, right? But we'll see as things evolve, right? So that's as far as gift city goes. I think previously you had mentioned about the co-investment side, right? And
Yeah.
again, co-investment is an opportunity set that potentially is available. And this is also because, as we said, right, we have this ability to sort of identify and assess late stage stroke private equity sort of investments that potentially are available, right? So on the co-investment side, that is something that potentially is available for investors, particularly on the AIF side. While today, as we speak, 100% of the portfolio is public. Going forward, subject to a few things falling in place, we could have the potential to invest up to 10% in late stage private businesses, right? And
Which
one of
are
the ways that
pre-IPO ready. Yeah, pre-IPO.
pre-IPO kind of thing, right?
Yeah.
So again,
Yeah.
that is subject to our deep work, our deep understanding, valuations, opportunities, and many other things, right? Again, we don't want to chase fads and themes,
Yeah.
because that does not end up doing well. But in the event that certain opportunities came up and we were able to sort of invest in them through the fund, then that particular opportunity would also be available for some of our investors on a co-investment basis, right?
Yeah.
And we say this because we have the access and the wherewithal to be able to identify and generate some of these investments, right? Because that's
Yes.
again not open for everyone, right? And I'll give you an example of this, right? So today, through our offshore vehicle, we are about less than 1.5% shareholder in Lenskart, right? So we
Mhm.
sit on the cap table of Lenskart. Now, today, I would make the argument that Lenskart is probably, by far one of the best late stage investments to make, right? They're fairly advanced in their IPO process. They will
Mm.
probably get listed towards the latter part of next year, right? And so because we are already investors there,
Yeah.
we have great access. Potentially there could be an opportunity for someone to be able to
Mm.
uh,
Consider.
invest
Yeah.
along with that, and it's a phenomenal business, right? Great consumer sort of brand, massively scaled, and profitable, right? And I would say that today it's probably the best unlisted business that exists out there, right? And as the listing happens, that value creation will continue. So I think that's just an example of some of the things that we are able to do that again many others may not have access to as well, right, Venkat?
Yeah. Yeah. Fine. And you will be considering the accredited investor framework. Just wanted to understand because some of my
Yeah,
investors are
that's
interested in that.
yeah.
Because
So
of the
that's what.
ticket size, I
Yeah, I
wanted
think
to
that
have
10
that.
crores is the number, but subject
Yeah.
to, I think that we are geared from our side to be able to sort of so work with that. So we've not done it so far, to be honest with you,
Okay.
but certainly we are well geared to be able to accept that, subject to whatever regulatory conditions that exist.
Yeah. It's great. It's great listening to you. Any final thoughts you would like to share it to my investors on your?
Yeah, no, so yeah, so just coming back to the more relevant and contextual sort of conversation, right, which is around politics and elections and things like that,
Yeah.
right? I think it's important. Yes, there is short term, dislocation, if you can call it that. But I think, if you were to look at India over the next 5 or 7 years, I think the broader story is very much in place. There are many things where, the momentum has a life of its own, right? And there will be many things that we'll see being done as well, right?
Yeah.
Which will have implications for investors. I think, the key takeaway is that, and like we've always said, right, India has done well in spite of elections or politicians or
Yeah. Yeah.
politics or what have
Yeah.
you, right? I
True.
think
We
the
will become the
history
third largest economy in the next 5 years. That's for sure.
in 5 or 6
Yeah.
years. It may not happen in 4 or 5 years. It may
Yeah.
happen
Correct.
in
6 years.
7, right? But
Yeah.
getting there is
Yeah.
almost sort of inevitable, right? I think
Correct.
that's where it is, and I think the past history has always shown, right, that in case there's any big shock that happens, very often that shock provides the best time
Time to invest.
for longer term investors to come in, right? It's the time to be brave, but at the same time it's also very important to focus on fundamentals, right, and not
Mm.
necessarily
Mm.
on narratives. And I think that's
Correct.
the discipline that each investor needs to have, right? So less on extrapolated narratives, more on businesses. And it could be busy, it could be a great PSU business as well, right? So I'm just to put that disclaimer, right? It's just that the business has to be trading at valuations which are supportive of any kind of reasonable growth, right? And
Yes.
if that is something that you can get confidence on, um, then it's great. I would finally also say, Venkat, right, one of the lenses which we use as we think about investing and investment opportunities, right, is what I might call special situations, right? And very often, shocks and dislocations cause some of these special situations to start to emerge, right? And I think
Yeah.
that's also a fairly sort of differentiated lens that we have, right? And we are always on the lookout for some of these opportunities, right?
Yes.
And
Yes.
this could manifest in 3 or 4 different forms. Hopefully we'll get to talk about that in subsequent conversations, right? but it's in essence it's just good businesses that start to go through a bad time, which gets factored in lower valuations, and then you sort of buy it when the news is the worst, right?
Yeah.
And then even a small some of these consumer businesses are great examples. And you
Yeah.
know fortunately for us, we were positioned reasonably well there, right? Because we had bought into a Marico Dabur last year, right? So like you said, pretty much for 1 year nothing happened, right?
Yeah. Yeah.
And then and Marico is up, I think 22 odd percent in 1 month, right? So effectively, that's the kind of thing, right? I mean, you need to have the patience, hopefully some conviction, right? So there's a lot of momentum going on last year.
Yeah.
You can imagine we were holding 4%, 5% in Marico, right? And Marico would move 2% up or down, right? So nothing happened, and then suddenly you had 45 days where Marico is up 21%, right? Or thereabouts. So you
Yeah.
get 1 year's return, but it doesn't come. It comes in 15 days, right? But
Yeah.
ultimately,
Non-linear. Yeah.
it's a non-linear kind of thing. So we are okay with that, right? It doesn't matter whether returns are front-ended, middle-ended, rear-ended, or what have you, right? I mean,
Yes.
as long as the returns are delivered because the business is doing well, right?
Yes.
And so I think some of that positioning, as you look into our portfolios, you'll see that sort of hopefully differentiated positioning, right?
Yes.
And like I said, I think if there is increased volatility, then there will be many more of these special situations, and I would say that we are quite uniquely positioned for that as well, Venkat.
Yeah. Thank you very much. We are very happy to have you on the show, and I hope
All
it
right.
gives a very good insight to my investors. Thank you.
Yes,
We
yes.
will
Thank you.
connect
No,
again
thank you,
in the
Venkat,
future.
for taking the time, the opportunity, for your help and support. It's always great to have these conversations because you hopefully get to hear how we think, right? And I think that's the
Yes.
most important thing.
Yeah.
So hopefully, look forward to doing many more of these as we go forward.
Yeah. Thank you very much.